Sound money, in my opinion, is money that can't be controlled by the government, that comes from outside of the government. And of course, before 2008, that was always gold. And, gold was written into the US Constitution. And, we all know, the history of paper money. And as Voltaire said, they all go to zero eventually, which is their intrinsic value. And so sound money is money that is immutable and real and can't be just printed by pushing a button on a computer. And like I said, gold used to be sound money, and I was a big gold advocate, still am a big gold advocate. I've pivoted in the sense that as Bitcoin came along and became more and more credible, and the bugs got worked out, so to speak, I've become more and more confident that Bitcoin is actually even sounder money than gold, because its stock to flow ratio at the next halving is going to be lower than the stock to flow for gold. So really, sound money is just, I consider it to be honest money. It's money that a government can't dilute. And when they print money, they're creating inflation, and that's stealing from everybody who has money. So it's stealing from savers and wage earners, and often they're printing that money to lend it at very low rates to the people who are closest to the printer, and that creates what we all call the quintillion effect, where those who get that cheap money are able to buy assets before the rest of us, and therefore they benefit and they get fabulously wealthy as a result of their privilege of being close to the printer. So sound money is just it's gold in analog form, old-fashioned sound money, not as exciting as Bitcoin, probably not as much upside as Bitcoin, because it's pretty fully distributed. It's been around for 5,000 years, but widely recognizable, and not as volatile as Bitcoin. Big down year in gold is 20%, and those don't occur very often. And then of course Bitcoin is emerging digital sound money, and I really believe Bitcoin is digital gold. And the fact that the supply is capped actually makes it deflationary money. I mean, the supply of gold grows a little under 2% a year. 40 years, there'll be twice as much gold on the planet as there is now. As we all know, Bitcoin's capped at 21 million. And so it makes it something very unique. And this, I think a lot of people miss this. The SEC has deemed it a commodity. Saylor has called it a commodity. We all believe it's a commodity. I mean, there is no CEO of Bitcoin. There's just a system of 21 million coins. And, or there will be 21 million. There aren't today, obviously, 19 growing towards that. But, it's the one commodity. If you look at any other commodity in the world and you were to say double or triple its price, well, guess what? You get more supply. If the price of oil doubles, we'll drill for oil in places that are marginal. If gold doubles in price, we'll find and explore and pull more gold out of the ground. Wheat, same story. Anything, any commodity really. Push the price up, you get more of it. Well, here's a commodity, Bitcoin, which has a fixed supply, and it doesn't matter if the price is $1 million a coin, there's never going to be more than 21 million of them. And so that's a very, very unique characteristic that I think everyone in the world is kind of coming to grips with and trying to decide how they address that. And the other thing I would say that I think is related to that is that, compared to all the other cryptos, which are, have CEOs and, funky monetary policies, this policy got embedded in code. It would take a majority of the users to change that code. That's not going to happen, in my opinion, and I think it's very unlikely to happen in most people's opinion. And as a result of that, you've got ultimate digital scarcity. It's truly a technical invention that didn't exist. So you have to think of this thing, in my opinion, as, like a printing press, or like an internet, or like an automobile, or, it's really it's a technological breakthrough. Prior to this, anything that was digital could be copied. And this could be copied too. I mean, somebody could do a competing Bitcoin. The thing is, we're so far ahead now, the network effect is going to carry us. It'd be like saying, I was arguing with somebody on Twitter this morning, well, why isn't there another internet based on something other than TCP/IP? Well, because TCP/IP is so good and it works so well, and everyone's on the internet. Try and get everyone to change to something else would make no sense. And I think that's what's happened with Bitcoin. It's now far enough down the road that there's not even anybody in second place, and it's very unlikely to be supplanted. Just as probably Google is unlikely to be supplanted as the leading search engine. So, and that's the network effect. So it's a really, really unique technical innovation that we are all coming to grips with. And I think if people aren't taking the time to try and learn about it and understand it now, they're gonna regret that in 10 years. Because if you kind of extrapolate out these network effects, I got involved in the internet very early in the early 90s and bought some internet companies, private internet companies, and I couldn't see where it was going, but I sensed it was growing. It was going to be important. I didn't know how important. And of course, even I've been pleasantly shocked by how important the internet has become. And I think it's a similar kind of thing. I think Bitcoin is going to become extremely important in the world on a going forward basis, and we're still really in the early adoption stage. I mean, it's unlikely that more than 10% of the world is aware of and owns any Bitcoin, probably less. So
can our current economy move to one of these sort of currencies that is, as you said, immutable? It's sort of got a fixed amount of supply, because I guess the challenge is that you need money flowing throughout the system. You need this velocity of money going between people. If there's not as much of an incentive to, I guess, sell your Bitcoin or sell your gold because you think it's going to appreciate, that could create these sort of deflationary periods where there's not enough capital. And I guess you could
yes and no. I mean, there'll be a natural low-level deflation, which really kind of occurred. I mean, if you look at the last time we were on sound money in a meaningful way, in my opinion, it was the United States from 1789 to 1913, before the creation of the Federal Reserve. And there were periods in there where actually we went off sound money, like in the Civil War, they issued greenbacks, which diluted the underlying dollar and so forth. But in general, during that period of time, dollars, which was kind of the unit of account in America, were exchangeable for gold, and there was only so much gold in the world, and so that provided a natural break on how much money could be printed. And people, the Keynesian view is that if you don't have money supply growth, you can't get real growth, and that's just bullshit. I mean, it's a flawed notion that you have to grow the money supply to have economic growth. What Keynes called animal spirits. I mean, look, people are going to always buy what they need. People want to eat, people want to have houses, people want to drive cars. They're not going to necessarily buy things they don't need, and I think the world would be less consumption oriented on a sound money standard. But I can make a pretty strong argument that would, for the world in general, that would be a good thing. If people spent less time worrying about consuming and more time just consuming exactly what they needed.
Small ebook, big impact, the wealth tree. The only 4 ways that will make you financially free forever. Download it here for free. The
other thing about a deflationary monetary standard is you can save, and over longer periods of time, you can have some confidence that what you have saved will hold its value and its purchasing power. And that's it's called long time preference. And that's a really great thing because it allows people to have leisure time. It allows people to retire. It allows people to get off the treadmill of feeling like you always have to make more money because the money you've got is going down in value. And as a practical matter today, it's very hard for anybody to retire because depending upon how long they're going to live, they don't know if they're going to have enough money. If the inflation is very high, the money they've saved may not buy them what they need in their retirement. So, and to me, that's not right. If you look at, you might say, well, okay, the last time we were on sound money, there was no inflation, but okay, that's true. The inflation was quite low during that 1789 to 1913 period. Having said that, living standards improved enormously during that time frame. I mean, we went from being, because of technological innovations and other things, but we went from being a nation of farmers to being a full-fledged leading industrial country. And so you don't need monetary growth to have economic growth, because what really matters is what we call real growth. I mean, if your economy, if your revenues in your economy, your GDP is getting bigger at 3% a year, but you're diluting the money, you're growing your M3 at 3% a year, you're not really having any real growth. The numbers just get bigger. And so, real growth is what's the, how many more goods and services get produced, in real terms as opposed to in nominal terms.
From your perspective, how long does this current fiat system have? Or
that's the $64,000 question. I wish we all knew the answer to that. Yeah, it's a great question, and I've tried to put some borders around it, and I'll give you my best guesstimates, and that's really all they are. And I'll caveat this by saying that I thought it was all over in 2008. Okay, so that gives you so don't trust me, right? It's been a long time since 15 years since 2008. So it feels to me like this is a fourth turning, which is a model that Howe and Strauss, a book they wrote about how every 80 years kind of the basis of society gets overturned and new rules get put in place. And it feels to me like we're going through that with this monetary system, with all the debt growth and the money printing and so forth. And so if you look at prior fourth turnings, which would include kind of the Depression and World War II, or the Civil War, or the American Revolution, or they document it all the way back to the 1400s, but they tend to last about 20 years. And so let's assume you kind of started this one in 2008. In 20 years would take us to 2028. Some last as long as 30 years. So maybe we could go to 2038. I mean, that's a big wide range, but I would think that somewhere between 2028 and 2038, and probably on the shorter side, probably in the 2031 or 2 area, we've transitioned back to a sound money standard because the current monetary standard has fallen apart and failed. We're seeing all the signs of that, the most recent one being the collapse of Silicon Valley Bank and First Republic and the bailouts. I mean, the government's just kind of locked in a doom loop of, they try to restore soundness in the money. That causes the marginal stuff to blow up. The blowing up causes a lot of pain and trouble, and then the government has to print again. And this all kind of goes to, Max Kaiser's line, you can't taper a Ponzi. The system as it's currently constructed needs an ever-growing supply of money and or credit, and credit really becomes money. When you borrow, you get money for what you borrow, in order to go forward. And the problem is, as my Twitter account shows, I've got a chart, my pinned chart at the top of my Twitter account shows a red line, which is the total all sector debt, and a blue line, which is GDP. And we've gotten to the point at which all sector debt is growing so rapidly compared to GDP that we don't have enough GDP to service it. And in my opinion, we hit peak debt growth at the end of 2021. And they're now trying to stop it. And that's why Bitcoin's down and gold is a little soft. But they can't. I mean, they can for a while, but as they do, things break. Silicon Valley broke. Before that, the British pension funds broke. Before that, we had a repo blowout in 2019 that caused them to, stop tightening. Before that, we had the taper tantrum in 2018. Before that, somewhere in there we had COVID too, which is the big one. But and before that, we had, Latin American crisis. I mean, you name it. So the point is that they need to continue to print money, and that printing of money dilutes the value of every piece of money out there. And so, investors and people who are operating in this world, in my opinion, need to choose sound money alternatives. And sound money alternatives, easily defined, is just anything the central bank can't print. So real estate qualifies. The problem with real estate is you can't move it, and they tax it. The nicer things about gold and Bitcoin is Bitcoin's extremely easy to move. Gold's a little tougher, it's heavy, and they can tax it, but they got to find you to tax it. And in Bitcoin's case, it's not so easy necessarily to find you. So I don't know, does that answer your question? I mean, that's kind of my general view on that.